If you're a student loan borrower on the SAVE plan, the next notice you receive after July 1st could be one of the most important loan updates you've seen in years. At first glance, it may look like just another routine message. But this time, the decision you make could affect your monthly payment, your budget, and even your path to loan forgiveness. Here's the catch. Doing nothing doesn't necessarily mean nothing happens. If you don't choose a new repayment plan within the deadline your loan servicer gives you, you could be automatically moved into a different plan. And that automatic choice may not be the best one for your financial situation. That's why it's important not to ignore these notices or assume everything will work itself out. The biggest change is that the SAVE plan, short for Saving on a Valuable Education, is being phased out as a long-term repayment option. According to the Department of Education, loan servicers will begin notifying SAVE borrowers starting July 1st and giving them a limited window to select a new repayment plan. If no action is taken, borrowers may be automatically enrolled in either the standard repayment plan or the new tiered standard plan. And that's where things get serious. If you originally chose SAVE because it kept your payments affordable based on your income, moving into a fixed payment plan could lead to a much higher monthly bill than you're expecting. For many borrowers, SAVE was attractive because payments were tied to income and included protections that helped prevent loan balances from growing due to unpaid interest. That flexibility made a huge difference for people already balancing rent, groceries, childcare, insurance, and other everyday expenses. Now, the repayment system is changing. The administration says the goal is to simplify a process that many borrowers found confusing. And honestly, student loan repayment options have been complicated for years. But fewer choices doesn't automatically mean better choices. For some borrowers, losing a plan that worked well could create new financial challenges. Starting July 1st, two new repayment options enter the picture: the Repayment Assistance Plan, commonly called REPAYE, and the Tiered Standard Plan. REPAYE is designed as an income-driven repayment option. Monthly payments can range from 1% to 10% of income, depending on earnings, and borrowers may receive additional reductions for dependents. The plan also includes features that can help prevent balances from growing, including unpaid interest relief and potential principal reduction benefits. Those features sound attractive, especially if you're worried about your loan balance increasing over time. But don't focus only on the benefits. Compare the actual monthly payment you'll be required to make. A plan can offer great features and still cost more each month than what you're used to. The Tiered Standard Plan works differently. Instead of adjusting payments based on income, it offers fixed repayment terms ranging from 10 to 25 years, depending on how much you've borrowed. A longer repayment term may lower your monthly payment. However, it could also mean paying interest for a longer period and spending more overall throughout the life of the loan. Before choosing any plan, ask yourself a few important questions. Is the payment based on my income or my loan balance? How long will repayment last? What happens if my income goes up or down? And most importantly, does this plan support any loan forgiveness program I'm working toward? That's especially critical for teachers, government employees, nonprofit workers, and anyone pursuing public service loan forgiveness. Your goal isn't just finding the lowest payment today. It's making sure your long-term strategy stays on track. Also remember that not all loans are treated the same. Parent Plus loans, consolidation loans, graduate loans, and loans borrowed at different times may have different eligibility rules. So don't assume a friend's situation applies to yours. Your studentaid.gov account and your loan servicer's information are what matter most. The first step is simple. Log in to studentaid.gov and your loan servicer account. Make sure your contact information is current. Review your loan types, repayment plan, and account status. Then keep an eye out for your official notice and pay close attention to the deadline your servicer provides. And one more thing. Watch out for scams. Whenever major student loan changes happen, scammers take advantage of confusion. Be skeptical of anyone promising instant forgiveness, demanding large upfront fees, or claiming they have special access to repayment programs. Always work through official federal websites and your loan servicer. The good news is that July 1st isn't a deadline to panic about. Think of it as the beginning of a decision window. You don't need to rush, but you also shouldn't ignore it. The real risk isn't just that save is ending. The real risk is getting placed into a repayment plan you never intended to choose. So check your accounts, review your options carefully, compare both monthly payments and long-term costs, and make sure the plan you select fits your income, your budget, and your financial goals. A few minutes of attention today could save you from a major payment surprise down the road. If you found this video helpful, make sure to subscribe for more student loan updates, hit the like button, and share this video with anyone who may be affected by these changes. And let us know in the comments, are you currently on the SAVE plan, and which repayment option are you considering next?